Hello guys, welcome back to Profit Quest. Today we will be starting Unit 5. My name is Adarsh Kannappan, and Unit 5 is about the stock market and investments. Let's start. So, before we talk about stocks and investment, we first want to talk about how stocks really work. So, step 1 is the ownership of the stocks. So, essentially, you'd be buying the stock that you can potentially profit from. And if you don't know what a stock is a sort of part of a company that you could own by buying. So if the company performs really well, then the stocks in that company increase in price. And if you pay for a stock, then you can sell that stock to sell it for an increased price than you paid for if the company is actually doing really well. So step 1 of how stocks work is ownership. Obviously, you're going to have to buy the stock for you to do anything with it at first. Step 2 is market dynamics. So in the second step of, stock and investment trading, you want to analyze the stock market. So how your stocks fluctuate. So if your stocks are doing really well, they're increasing and increasing, that may be an indication of that it's time to sell your stocks, or you might want to wait. But if it's decreasing and decreasing, that may be an indication that the company itself isn't doing well, and that's not really good for you. So remember that, when you buy a stock, to always analyze and check how the market is moving. Step 3 is investor returns. So once you buy the stock and you see that it's at a good point, so it's much higher than when you bought it from, you can sell it for a profit. So you can sell your ownership of the company back to the market to gain the money that you gained because your stock has increased in value. And step 4, this is not really a step in how stocks work, but it's kind of a marker for, what you should buy and what you should sell. They say more risk, more reward, higher risk, higher reward. And that's because when a stock is at high risk, that means we don't really know what's going to happen to it. There's a chance it could increase, or there's a chance it could decrease. So if we buy a stock that has a high risk, and it increases, it goes in our favor and it increases, it might increase drastically. And that drastic increase could cause an extreme increase in our assets and give us an extreme profit from the stock that we bought. So, a general overview of stock is a share that represents ownership in a company. So, let's say Apple has a certain amount of stocks. So, let's say I don't actually know how many stocks Apple has currently, but we're going to use the number 5 million as a marker because it's, easy to use. So, let's say Apple has 5 million stocks. To own 1% of Apple, to own 1% of the company through your stocks, you would have to buy approximately 25 million stocks. Oh, my bad. To own 1% of the company, Apple, if it had 5 million stocks, you'd have to buy approximately 50,000 stocks. So let's say you want to buy, let's say each stock is worth $200. Now this is just like a general estimate. Obviously Apple stocks are probably going to be more than $200 and it probably has way more than 5 million stocks. But if each stock is $2 million or $200, then you would multiply 50,000 by 200 to get 10 million. So you'd be paying $10 million to own 1% of the company, which is crazy. But as Apple has been increasing in recent times, it could be an indicator that, okay, this 10 million is going to go into buying the stock now. But then once I pay the 10 million, it's going to increase in the future to maybe 11 or 12 million so that I can buy it. So guys, investing in the stock market is always a long-term game. You shouldn't invest in the stock market if you expect it to pay out the next day or the next week. You have to wait. It's a patience game. So this was just a basic overview of how stock trading works. Thank you for completing Module 1 and tune in for Module 2.